Hey, what's up, future homeowners? Today we're tackling one of the biggest decisions you'll make when buying a home, picking the right interest rate. Now, I know what you're thinking. Interest rates? Sounds pretty boring. But hey, stick around because by the end of this video, you'll be picking your rate like a pro, and you might even have some fun along the way. So you're thinking about a fixed rate mortgage? Let's start here. This is the reliable choice, the old faithful of mortgages. A fixed rate mortgage means your interest rate stays the same, month after month, year after year. No surprises, no roller coaster rise. What you see is what you get. On the other hand, an adjustable rate mortgage, or ARM, is like a supreme pizza. Lots of stuff going on. The rate starts low, which is awesome, but after a few years, it can change depending on the market. So if you're planning to stay in your home for a short time, this might be your jam. That said, we'll cover that in another video because I don't want to lose you.
You almost did.
Before we talk about how to pick your rate, let's talk about what determines your interest rate. The rate you get isn't just picked out of a hat. It's based on a few key things. First, let's start with what's out of our control: the United States economic situation and policy. This is the biggest driver of interest rates. And no, the Fed doesn't decide your mortgage rate.
Are you sure about that?
Your mortgage rate is correlated to so many things, but at its core, it's the yield on the mortgage-backed security bond.
My nose is bleeding.
Have I lost you yet? Well, don't worry. It's out of our control anyhow. Just know that interest rates can and will move up and down without you even knowing it. So timing can play a part too.
Noted.
So what's in your control? First up, credit score. The better your score, the better your rate. Simple as that. Want to win that prize? Keep that credit score as high as you can. High. Most banks nowadays have free algorithms that will give you a general idea of your score. Use that as a baseline to make sure you're monitoring your score for any drastic swings. Stay on top of it if you can. Next, down payment. This determines your loan to value. The more you put down, the less risky you are for the lender, and that could mean a lower rate for you. Unless, of course, you're a veteran, where a no down payment loan is your earned right and won't affect your interest rate. And lastly, here's the miscellaneous category: property type and occupancy, single family versus condo versus manufactured home versus multifamily, and so on. Primary residence versus second home versus investment property, and so on. Different property types and different occupancies will display different interest rates. There's a lot to unpack here, so I'm going to keep it simple for you. Just know that the more you stray outside of a single family primary residence, the more you'll pay to play. Okay, let's assume you've got it all sorted out, and let's take it a step further. Once we've dialed in your property type, down payment, debt to income, and credit score, we're going to land on a rate sheet. Remember, the system doesn't just spit out a rate. It's all about options. And there are a lot of options. A good lender will sit down with you and talk you through your options to find the most efficient rate available for your situation. We'll talk about longevity goals, the current rate environment, and trends to make sure you're choosing the best rate for you and your family.
I'm so grateful.
Remember when I said that you'll have choices? Well, let's talk about why. On the top of a rate sheet, you're going to have lower rates with higher costs. In the middle, there will be a rate that has no cost. We call that the par rate. And at the bottom, there will be higher rates that provide a rebate. You can use this rebate to cover closing costs if that's more important for you than your monthly payment.
Not half bad.
So what are these costs for lower rates in mortgage jargon? They're called discount points. And no, I don't mean reward points, though I wouldn't mind some extra coffee points myself. I'm talking about discount points. You can pay these points up front to get a lower interest rate. Think of it as a little extra money now to save big later.
I like the sound of that.
So here's the million-dollar question. Should you pay points to lower your rate, or just stick with the standard par rate? It all depends on one key thing. How long are you staying in your home? If you're in this house for the long haul, like 5, 10, 15, or 30 years, then paying points up front can save you a boatload of cash over time. Here's an example. Let's say you pay one discount point. That's 1% of the loan amount. On a $300,000 loan, that's $3,000 up front. Sounds like a lot, right? But if it knocks your interest rates down by, say, 1/4 or even 0.5%, you're saving maybe $50 to $100 a month on your mortgage payment. Over a year, that's $600 to almost $1,200 in savings. Over 5 years, that's $3,000 to $6,000. See where I'm going with this? You keep saving money every month. So the longer you stay, the better deal those points become. Every rate has different discount points associated with it, and they're almost never aligned in even numbers. The key is figuring out your break-even point. That's the moment when your savings from a lower rate matches what you spent on points.
What the hell are you talking about?
Confused? Yeah, I get it. It's my job to break it down for you so you know exactly what you're paying, if anything, and how long it would take to break even. You can count on that. But if you're not planning to stay in your home for more than a few years, paying points might not make sense because you won't be there long enough to enjoy those savings over the long term. It's like paying for an annual gym membership when you know you're only going to use it for a month. Probably not worth it.
Maybe I'll hit the gym.
So, quick recap on the do's and don'ts of paying points. Do pay points if you're planning to stay in your home for a long time. You'll save big in the long run. Don't pay points if you're only staying in your home for a few years. You probably won't see the savings you're hoping for. And do talk to your lender to run those numbers and figure out what works best for your budget. All right, future homeowners, here's the bottom line. If you're all about locking in a low, predictable payment and planning to stay in your home for the long run, a fixed rate mortgage with points could be your winning combo. But if you're moving around or just don't have the extra cash up front, no worries. Going without points can still be a great move. Remember, I'm here to help you navigate all of these choices. So drop a comment, give me a call, or let's set up a time to chat. Together, we'll find the perfect rate for your dream home. Thanks so much for watching. Don't forget to like, subscribe, hit that bell so you never miss another video tip. I'll see you on the next video.